Hello and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott Asset Management. I'm pleased today to welcome back both Fred Hickey, founder of High Tech Strategist, a monthly investment newsletter with over 30 years of intensive market research, and John Hathaway, Managing Partner and Senior Portfolio Manager at Sprott Asset Management, with over 5 decades of investment management experience. Gentlemen, thank you both for joining Sprott Radio.
Glad to be here.
Thanks, Ed.
Well, John and Fred, let's go back 2 years ago when we had our last conversation on Sprott Radio, and effectively it was a macro gold roundtable. Today I want to talk a little more broadly about what's going on in the general markets. So, Fred, let's start with you. I know 2 years is a lot to cover, but what's been going on over the last 2 years?
Well, we've had a reemergence of the stock bubble. What happened was that we had huge declines in the stock market in 2022 and the worst bond market in history in 2022. And then Treasury Secretary Janet Yellen found a way to get some more money into the economy and into the financial system by taking down what was called the RRP account, which had its reverse repo account, which had $2.5 trillion in it at the time, at the beginning of 2023. And now it's down to $400 billion. By issuing lots of treasury bills, she was able to pull out $2.1 trillion. And much of that went into the stock market, just as the money that was printed in QE1, QE2, QE3 plus did back several years ago. Not to the consumer, as it did when the Fed printed $5 trillion and the government handed out stimmy checks. That lifted consumer inflation. This has been financial inflation. So as a result of that, we've had a huge reemergence of this bubble, and that's where we are right now. And that bubble's feeding the U.S. economy because much of the economy is very weak. Retail sales are weak, and housing is a disaster, and many other areas. Industrial production is soft. It's all the wealth that's been created that's lifting the U.S. economy and making it the strongest economy in the world right now.
Well, and that's a good point. Strongest economy in the world. I think on the surface, things look like everything's working. The economy's working. Employment seems to be in check. Inflation's coming down. Feds hasn't lowered rates yet. And yet gold's doing well also. So, John, let's shift to you for a minute. Have you been surprised by the strength of gold, given that everything seems to be rosy right now on the surface, but yet when you go underneath, not so much? What do you think about that? And where do you see gold right now versus going forward?
Well, 2 things. First of all, the strength in gold has nothing to do with U.S. investors or European investors. It's all about central bank buying, and the reason central banks are buying, it's mainly the BRIC nations, which are trying to rearrange the plumbing of global commerce away from the U.S. dollar. And that has all kinds of implications down the road, which we won't have time to get into today. The other thing, and you in your question to Fred, which I kind of like to go back to, is the general perception and the complacency that Chair Powell is going to stick a soft landing. And there won't be any sort of long negative consequences from higher interest rates, 5% on the short end, and again, we have an inverted yield curve. So I think we should come back to that point because it seems to me that part of the complacency and what Fred talked about is the issuance of a lot of short-term treasuries, which have basically inflated financial assets. And Fred, you mentioned in your letter that that might be coming to an end. So, what if we have something which the vast proportion of the investment world is not contemplating or positioned for, and that is a recession? I mean, everything I look at, and I confess to not being an economist, and I'm proud of it, but all of the, the restaurant sales, hotels, a lot of these consumer discretionary sectors are rolling over. So I think we should talk about that a little bit more.
Yeah, it's really only the high end that's doing well right now. I saw a survey that showed that 65% of people making over $60,000 a year are suffering financially here. So it's the wealth that was created in these last couple of years that's keeping people traveling around the world, going to concerts and sporting events, and paying huge dollars for them, by the way.
Yeah, ticket prices for concerts and sporting events are crazy.
Right. And so that's lifting part of the economy while much of the rest of the economy is suffering. So it's really a bifurcated economy, and that's problematic if the wealth goes away. And if the wealth is being determined by a handful of stocks, as it is, as of last week, 3 stocks, Apple, Microsoft, and Nvidia, were worth $9.9 trillion, which was more than what the whole Chinese stock market was worth. It's epic. The valuation levels are higher than they were in 1929. They're higher than they were in 2000 on a price to sales basis and a price to market cap basis. It's really intense, and it's very narrow. 10 largest stocks are accounting for almost all of the gain this year in the stock market. And you see the breadth. Bank of America put out their report last week, and they talked about breadth being breathtakingly bad. Well, yes, the average stock is not doing well. The Russell 2000 is actually a little lower than it was in 2021. So it's these small number of names, and if they break, as they will, because they're grossly overvalued, then the wealth effect could go away. And then it joins the rest of the economy, and then you have a recession.
Why do you guys think that the world's not really paying attention to that? Because to your point, the high end is still traveling, spending money and so forth, but the middle and certainly the bottom end is starting to struggle. Again, on the surface, it seems like things are going well. Why is no one really focused on this or paying attention to this? Or is this classic kind of peak market behavior?
Well, it's convenient to the consensus view of the stock market. I mean, if the things that Fred and I think are more likely to happen, then you wouldn't have valuations at these levels. And so I think it's just convenient to avert your eyes to the reality of the struggles of the middle and lower classes.
Well, let's talk about some of the things that are more likely to happen. In your mind, if you had to pick, say, 2 or 3 things that you're concerned about today, and again, John, let's stay with you for a moment on this. What are some of those things that our listeners should be thinking about?
A lot of what Fred's talking about, the overconcentration, the risk in the markets at these valuation levels. And, Fred explained it very well. And if that is the single strand or one of the few strands that's propping up the economy, and if that is to go away, then I think there are some rude shocks lying ahead for people that are, there's no other word for it. They're just complacent, averting their eyes to the kinds of things that we're talking about. So I'm sure Fred has some thoughts on that too.
Yeah, Fred, thank you, John. And Fred, what are you thinking about that? What other speed bumps are out there that are obvious to you that maybe others aren't paying attention to?
Well, no one in Washington, at least, is paying any attention to this tremendous spending by the U.S. government. Now they just increased the deficit estimate, the CBO, by 27% last week, down up to $1.9 trillion, and that's in a non-direct war scenario here, and also in an economy that's still growing. If you go into a recession, you're going to be seeing $3 trillion deficits and nearly $35 trillion in debt, and that's a problem when money seems to be drying up a bit. The liquidity in the U.S. Treasury market is extremely low, and we've seen many auctions now not fail, but do poorly. So there isn't as much demand anymore, and part of the reason is the Fed is not buying anymore. They were the largest buyer. There's still tightening with QT, quantitative tightening. That's not the level it was, but it's still $60 billion a month. And then you don't have that RRP account, which they've been tapping into. It's tapped out. And that's one of the reasons why the breadth is so poor in the stock market. There doesn't appear to be enough money to lift all of the stocks. So it's getting narrower and narrower. And that's what happens at market tops. It's very dangerous.
Well, you just talked about recently in the current newsletter, which I thought you did a great job, really covering kind of what's going on out there today. Peak Gen AI hysteria. Is that one of the symptoms? I mean, talk about that, because what's going on in tech right now and how that's driving things, to me, seems obvious that this is not sustainable. But can you expand on that a bit?
Well, usually when there's bubbles, there's a theme. We had the 2000 bubble, and that was the internet, and that was very valid, but it got ahead of itself, and they overbuilt. They overbuilt too much capacity in fiber optics and computer servers and all of that. We've had other great bubbles and canals and railroad driven, and sometimes though it's tulip bulbs, and this is somewhere in between generative AI. AI has been with us for decades. IBM's Watson was introduced almost 15 years ago. We've been making improvements in people's lives with AI. That's been going on for a long time. Nothing new. What happened was we had development of these large language models, which is the Gen AI part of it. And it's word salading. Microsoft saw the possibility of going after Google search, and they were going to use this OpenAI generative large language model to do so. And they poured all kinds of money into that. They put $10 billion into OpenAI. They then put a bunch of money into NVIDIA GPUs. When Google saw that, that triggered their buying, which then triggered Meta's buying and Amazon buying. The costs are high. The payback isn't there. And we're seeing it in the surveys. There was one survey a couple of weeks ago that showed only 5% of the companies that are trying to use this generative AI are only 5% are getting any kind of payback. And so as a result of that, there are cutbacks in spending and planned spending. and you can't have, so you have the stocks going crazy, going higher and higher and higher, yet the generative AI benefits are very low and the costs are high. What could go wrong there? Well, there's a reckoning coming.
And to that point, John, you mentioned a moment ago that it's really central banks and the de-dollarization of what's driving gold. But do you see gold playing a role in this AI shift or this AI hysteria? What's gold's part in all of this?
Well, the connection is that if the emperor has no clothes, and Fred has really explained it very well, I think people will look for other things to do to protect capital. And, gold would be one of the answers. And it kind of takes me to the question you asked earlier. What will be the next leg in the gold price? I think it will be a repeat of what we saw in 2000, the bubble bursting. Nobody can predict exactly when, but we can certainly explain, why it is a bubble, and, bubbles have a history of deflating. What would be the response of public policy to, the one thing that is propping up the economy? If that isn't there, then I think you would see much more in the way of deficits and much more in the way of, for lack of a better phrase, money printing by the Fed. So, a panic reversal, not a soft landing, but something that demands warp speed money creation. One is that you take away the thing that's been keeping investors' focus away from gold, and two, fundamentals that would basically depreciate the dollar even more than it has over the last 20 years. So to me, that's how you get to $3,000 or $3,500 gold. We're not there by a long shot, but I think that is certainly on the horizon.
And the difference is between now and 2000 is inflation really wasn't on the radar screen at that time. Whereas we've had a period of high inflation and we're still suffering for it. It's come down, but it's still high in a lot of areas like services and wages and that kind of thing. I mean, gasoline prices are up 19% this year. That's going to have another effect on the numbers going forward. So people are now aware of inflation. They saw food prices rise 36% over the last 4 years. Everyone's aware of that. It's a big issue in the election campaign coming up. In 2000, that wasn't the case. It wasn't the case. It is now. People are concerned about the debasement of the dollar. They're concerned about inflation, and that makes it harder for the Fed to act as they have in recent years quickly, because they do have to worry about inflation. It's interesting. In 2000, there was no interest in gold. We would see outflows, out of both stock funds and as well as the people selling gold. Today, it's different. We've seen the outflows from the West out of the ETFs. We've seen massive outflows. If that had been the case in 2000, we'd be down a lot in the price of gold, but we're not. And we're not because the rest of the world sees things differently than we in the U.S. do. And they're concerned about inflation. They're concerned about the debasement. They're concerned about de-dollarization. They're concerned about the weaponization of the dollar and what happened with Russia. And offsetting these hundreds of tons of gold selling that's occurred in the last couple of years is 1,000 tons of central bank buying in 2022. It's over 1,000 again in 2023. A record 290 tons in the first quarter of this year. And then buying by the people in all throughout Asia. And they're the ones that are really driving the gold market these days. So what we've had here is the price of gold that's gone up. It broke through record highs and triggered all kinds of technical buying because it broke through the 2070 level and it went further. And the chart looks great, and it's an 8-year cycle. It's the beginning of that. The cup and handle is in place, and it looks perfect, yet we haven't had any investment by the West, as John had spoken about earlier. And that's the piece that comes in once the stock market breaks and the alternative becomes potentially gold, especially with bond market being so poor, with rates going up over the last few years. The bond market has been a poor alternative. It isn't the safe haven it once was.
Well, Fred, you talk also in your most recent newsletter about China really attempting to curb gold's enthusiasm of moving higher. Talk about that, because you're right. It does seem like the West has sort of moved away from it as the East continues to embrace it. Yet even China was trying to dampen, unsuccessfully, the general market's enthusiasm. Can you unpack that a little bit and walk us through what you saw there and what you witnessed?
Yeah, I don't think they're trying to damp enthusiasm for gold. What they were trying to do is reduce the price. The price,
right.
Like, the first decline we peaked at 23.50 or something like that. First 23.70, I guess it was, and they raised margin requirements to try to dampen down the enthusiasm. And then most recently, we went up to another high, 24.50, and they came out and didn't say the Bank of China wasn't adding to the reserves, which you can't trust because they go for years and they don't tell you that they're buying. And I happen to know they were continuing to buy and they plan to continue to buy. The Chinese play games with prices. They do it in the copper market and other markets as well. They wanted to see that price come down. It was too high. But they weren't going to stop buying gold. They've been buying it for decades, and they will continue to do so. You just might not hear. They'll go long periods of time. I don't know what will happen next month if they'll announce that they bought again or not. I don't know that, but I know they're buying. So it's more of a damping down enthusiasm for the price and making it easier for them to buy at a lower level.
Well, speaking of that price, John, were you surprised to see gold not only break through that 2,300, but more importantly, hold that price? Or do you think it's still too low given the current landscape out there?
Well, I guess I wasn't surprised that it finally broke out of this 3 or 4 year period of consolidation, range trade between 1,800 and 2,000. I guess what surprised me is that it happened without any participation by folks in our part of the world. And what that suggests to me, when that latent buying interest gets activated, I would think that that's where our next leg comes from. And that to me is why it's so important to draw the connection between the stock market bubble and what would it be that would get people in our part of the world interested in gold again, which they haven't been.
John, you've seen this before. We talk about the West regaining interest in the gold trade. Can you draw some parallels to some other times where you saw the West really embrace this allocation and what that looked like, not just for gold, but let's also shift gears and talk a little about the gold equities or the miners and what that has looked like in the past?
Well, let's look back at the launch of GLD in 2004. It went from zero, I think, to Fred will probably have the number off the top of his head, but I think they added between 2004 and 2011, which was the peak, on the order of 500 or 600 tons. That
more than that, even more than that. It went up to a peak of like 1,300 tons.
Okay, thank you. Good. What if they tried to buy 1,000 tons or 1,400 tons in this market? With the Chinese not going away, probably still buying. Make up your own number, but gold to me is still underpriced at this level. And so, Ed, you touched on something that's near and dear to my heart, and I think maybe Fred's too, which is what's going to light a spark under these gold mining stocks. It's been super frustrating for me, who was an investor, our clients are investors in gold mining stocks, to see the lack of interest, even in the face of tremendous fundamentals, margins widening. Average gold price in the first quarter was something like 2,100. It'll probably be 23 or 23.50, something like that. And so margins are expanding and the stocks are dead in the water. I mean, yes, they've risen from depressed levels, but they're still, in my mind, nowhere where they ought to be. So I keep asking myself, what will it take And I'm guessing it will be disenchantment with the stock market as we now know it, and maybe sort of a disruption of this complacent view that the Fed will stick a soft landing and that we're facing a recession, forcing dramatic changes in public policy. I think a combination of those things will light a fire under the gold stocks. And, I'm locked and loaded. So we're just waiting for this to evolve, and I think it will.
I do think that this earnings period is going to be pretty dramatic for the miners, and that's going to draw some attention. I calculate the average price to be 2,340 versus 2072. So you're talking a $270 increase from Q1 to Q2. And, most of that's going to be increased margin for these gold mining companies. And so, it looks like it's a 35 to 40% increase in the margins on these companies. And their margins were pretty good for a lot of them in Q1. They're just going to be fantastic in Q2. And I'm hearing from the hedge fund community that they're starting to get interested in some of the bigger names. And I hadn't heard that before. And I'm talking about the stock market names. They've been involved in the gold and silver, but not the stock market names. But it's the institutional money that's not involved at all yet. It's the pension funds and insurance companies and those kinds of things that aren't involved. And that's what you see in GDX ETF, the same number of shares outstanding, 388 million, that they had 6 years ago when gold was half the price. It's stunning that there's so little interest in them. Yet they're not going to be able to avoid them if the earnings are going up and the stocks start to move as a result of that. It's a very narrow market. And I talked about just these small companies that are really all AI related. We've seen big declines in even the cloud companies. So 8 of the 10 top cloud companies saw near 10% declines in their stocks last quarter on their numbers. That's how narrow it is. So they have to look for other areas that might be performing. They're running up against limits to how much NVIDIA they can have and how much Apple they can have. So these strong earnings could help to trigger some interest.
John, I know you've mentioned in the past the general health of miners from a cash flow standpoint, from a dividend yield standpoint, all these different things, lack of debt on their balance sheet. But the naysayers would say, well, but the cost of extraction is going up, inflation is going up, and cost of employees is going up. Inflation is starting to sort of flatline right now a little bit from where it was, say, a year ago. So these margins are expanding. But I wonder if both you could give us a couple examples of really just how much quality we are actually seeing in these miners today.
I would not say that costs are going down, but the rate of increase is slowing down, and that equates to margin expansion. The other thing that strikes me is there are a number of companies that have just completed large new mines in safe jurisdictions. Think about this, that for years and years, they had capital that was unproductive because it was tied up in a mine build, which is, a torturous multi-year process. So billions of dollars that were sapping returns on capital will suddenly flip to producing returns on capital because they've started up, and in some cases, very large new mines. To me, that's something that gets even further down the road and more of a sweet spot than just margin expansion. It would be step changes in corporate cash flow from startups of big new mines. So that's kind of something that we're emphasizing in our stock selection. And I think it's, Fred, you've noted some of the names where this is taking place. And I think that's a dynamic element to fundamentals that will take us even further than the expansion of margins that we've already talked about.
Yeah, some of these companies are actually seeing, even with the inflation that's occurred in labor and some other areas, they're actually seeing declining costs because production is going up.
Does that make a case for, with all the ETFs and stuff out there now and this whole ongoing argument of passive versus active, does that make a case within the mining space to be more mindful of looking at active managers versus just a general ETF? Or how should investors think about that as they start to shift from looking at the physical market, like you're saying, Fred, from a hedge fund standpoint, to the equities or the miners? How should an investor who's listening to this podcast today start looking at or thinking about the mining stocks?
Selectivity is really important, not just buying the whole group. There's a lot of reasons for that. There's a lot of danger in not being in the right jurisdiction. And the higher the gold price, the more danger, because you see a lot of expropriation through various means, through taxes and royalties, an actual potential expropriation that could occur.
We've pretty much covered the waterfront on kind of general markets, both physical gold and gold equities. I'd be remiss if we didn't bring up silver just for a moment and, get both your views on how should an investor be thinking about silver, because in many investors' minds, gold and silver sort of go hand in hand.
Well, quickly, silver is gold with torque. It's got the lower price point of $28 an ounce versus $2,300 an ounce. It's more accessible to retail, and it's a monetary metal. It also has industrial usages, so that complicates the analysis. But at the right moment in time, it's a monetary metal on steroids. We haven't seen that yet, but just stay tuned for that. One of the issues is that there's a lack of really good silver mining equities. There are some. We could probably have Maria Smirnova on this podcast, and she would say the same thing, that she has trouble finding good mining equities in the silver space. There are some, but maybe just not enough to her liking. And so that would say to me that the ones that are pure silver plays, and if silver does sort of catch that monetary metal tailwind, those specific silver stocks should be outstanding performers.
And Fred, would you like to add to that at all? I know you've talked a bit about silver in some of your newsletters as well. I think you even mentioned it in the most recent one. Anything to add on the silver front?
Well, I agree with John how difficult it is to find good, well-managed silver companies in locations that are safe. That's another problem. It lags gold. It's typical. And then it takes off and does far better than gold.
One other thing I want to hit on before we sign off here is, we've touched on a little bit throughout the conversation today, the Fed. And John, you mentioned about a soft landing. From a report card standpoint, do you think the Fed's largely getting it right, or have they painted themselves in a corner? Maybe touch on that a little bit and what that could potentially look for gold longer term.
Well, I think what we've seen is the Fed is irrelevant so far because the gold price has gone up. The old mythology was high interest rates, strong dollar, blah, 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 bad for gold. Well, we've had that, sort of, and it hasn't been bad for gold. So what does it really matter in that sense? What I think does matter, and I'm no fan of the Fed at all, is I think they're in the process of making another big mistake, which they'll have to hit the retro rockets on their stance of supposedly tight money. I think they're sneakily getting away from that with shortening maturities on debt, and there are a number of other things that they're already doing, pulling back on quantitative tightening, running down the balance sheet. So they're kind of sneaky about it. I really don't understand the reverence for the Fed that you see in the general financial media. Maybe it's because there are a lot of guys that make a living just talking about it. I'm ready to see the Fed do a faceplant on their current stance, and I think that will just generate interest in what we've talked about.
Fred, I'm seeing some head nodding there. What's your thought on the Fed?
Well, I agree with everything that John said. In addition to that, though, they've been intervening in the markets constantly now for years, and each time the intervention has to get greater. And the last one was $5 or $6 trillion, and that doesn't count the $5 trillion from Europe, the ECB, either. And at some point here, the Fed's going to lose control. They're having trouble now. The Treasury Department's having trouble with these auctions, and people are starting to get more concerned about inflation. It's going to get very interesting. As we go forward, there may not be a tolerance for the kind of quantitative easing, the massive money printing, the debasement that's been going on to reach. Each time we have a crisis, it creates a worse crisis because they never let the markets correct completely. They don't let the excesses completely clear. We end up with more malinvestment, and we end up in things like all this money pouring into this stupid Gen AI stuff. And then that blows up, and then it forces them to once again come in. But now there's inflation built in. There are inflation expectations. And so I won't call them irrelevant. They may become very important going forward, but it'll be a loss of confidence rather than the confidence that people have today.
Fred, let's stay with you for a moment. Is there anything else you would like, any other points you would like to make that maybe I didn't address that you think our listeners would benefit from today?
I just think the timing is really good right now. We've had this correction. It hasn't gone very far, but it has corrected things, particularly in the gold miners area. They're going to have great earnings numbers, and there's a chance that we get really going here in the second half of the year.
Well, gentlemen, I really appreciate you both taking the time today to join us on Sprott Radio. I hope all of our listeners really benefited from this as well. Once again, my name is Ed Coyne, and thank you all for listening to Sprott Radio.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.